what do you think about as you get excited about the next 2 years?
Yeah, I mean, in what arena? We talking real estate markets or just any business?
Anything? I would. So Tom Nash and Minority Mindset were highly focused on stocks, dollar cost averaging, things of that nature, ETFs. They did both hit real estate. Certainly, Minority Mindset talked real estate, but you take us where you want to go. Your background definitely is more business, more buying businesses. So,
Well,
I would
the
love.
market's at the bottom. So I entered the markets at the bottom, but I'm not a dollar cost average guy in a bear market. That doesn't work, because you buy the dip, you become the dip in a bear market, and you just keep averaging yourself down, and that just really doesn't make a lot of sense. What you got to do is you have to understand where we are in the business cycle, and keep cash ready to take advantage of things. But we're not done yet. We haven't reached the bottom. We're not near the bottom. So this isn't the time to dollar cost average and start making big moves in the markets. You're going to get pops, but you're going to get drops bigger afterwards until we get inflation down, the Fed can stop, and we've got a clear signal from credit markets and banks and everything else out there right now that are under pressure, that are creating issues and problems. So that's the markets. We're not there yet. We're not done. A lot of Tom's younger. I don't know about the other channel. Don't know who that is. They haven't been through anything like this. They don't know how long this can last and how long it can take to recover. So if you're dollar cost averaging down, let's say you bought it at the top and you're trying to reduce your basis. Hey, that's great, but you could be down for a while. The last time we went through this, it was 10 years to get back to even.
Yeah.
So if you dollar cost average down low enough, maybe you made some gains, on the way up. But at the end of the day, with what you put in and where you're at, you're just breaking even over a 5 to 7 year period. And if you're down 10%, you got to go up 20, 25 just to break even. So a little bit different time frame there. When it comes to real estate, things like that, every market's different. Every type of property is different. The financing is the key to that. That's tightening up. Interest rates are also the key. So you have to be patient, time the market, not time it, but you got to be patient in terms of understanding where are we in the real estate cycle. This isn't the time in most markets because it's still correcting heavily, and we're not seeing big discounts in terms of a real value standpoint. You're seeing price drops from very distorted high levels of pricing, but you're not seeing price drops from where it should be before that big run up over the last 2 years. So that's pretty much all markets. And then when it comes to the entrepreneurial side of things and businesses, we're going to see lots of opportunities. Businesses are going to close. They're under pressure. There's a lot of vacant space out there. If you want to take over a space, do brick and mortar. There's never been a better time to do online business or a remote business or some sort of a intellectual capital exchange type of business where you sell what you know, or you help other people, coach other people, consulting, things like that. I mean, those types of opportunities are just huge out there right now. So there's a lot of things that are changing and have changed. But as far as overall bear markets go, you need to understand where you are in the business cycle and how much further this can go down and how much longer it can take to get back up.
Yeah, it's funny. On the daily financial news this morning on my channel, I found some stats about average bear markets. Every bear market since I think it was 1930. The bear market that crushed me was the 2000. Peak to trough was over 600 days. That's just peak to trough. That's not peak to return. That's peak to trough. 600 days. 49% drop for the S&P, or it might have been the NASDAQ. Might have been the NASDAQ. But again, just a huge haircut. And then the one that a lot of people got into was bear market of 2020. We had a bear market in 2020. It lasted 23 days. 23 days. That's not normal. But a lot of people kind of got used to that, V-shaped bottom. So I agree with you on the stock market. I'm going to wait until the Fed. I'm going to wait at least till the Fed pauses, or at least gives indication that a pause is coming. And I don't see that in the next 2 or 3 meetings. So we shall see. Plus, we haven't really seen earnings hit yet.
So 2000, I wasn't in the markets then, but I had people that I was building for that made a lot of money before the bust. They sold at the top, got out. And they were coming down to the beach and spending all their profits on beach houses. But I don't know what happened there from a Fed intervention standpoint after the dot-com bust. And, it was the NASDAQ that took the biggest hit. The Dow and the S&P didn't take that big of a hit in 2000. But 2009, again, it didn't stop until the Fed stepped in and
Yes.
Treasury stepped in and started propping up banks and things like that. So that's where that V-shaped recovery started coming from. But again, it's still off the bottom. It was a quick V, but it still took 8-9 years to get
Yeah.
back to even.
Correct.
2020, that was Fed intervention. So what we don't know is how far will the markets go down without that? How long will they stay down without that? The only reason we had recovery in the markets like we did, even in 8 or 9 years, was because of zero interest rates, or zero effective interest rates.
Yeah. Cheap
Fed
money.
intervention, Treasury intervention. And then in 2020, it was all of that on steroids, where they did more in 2 years than they did over the past 9 years leading up to that.
Absolutely.
So very distorted levels of everything: interest rates, asset prices. I mean, this is the biggest super bubble we've ever seen, where the Fed can't step in at scale and drop interest rates and do those things because of where we are from an inflationary standpoint. But they can do some other things and inject liquidity and prop up different areas and buy different assets that won't, at the end of the day, affect retail prices where we're experiencing the big inflation, but it will create asset inflation.
So when you're looking at the next couple of years and you're coaching students, I'm going to guess, please tell me if I'm wrong, a lot of people come to you because you're just such an amazing entrepreneur. And it sounds like what you're telling me, again, if you look at stocks, real estate, or entrepreneurship, it sounds like you're most excited about entrepreneurship. It sounds like taking over an existing business that may be just wanting out, tired, whatever the reason is, feels like the right area. And then I think the kind of cherry on top to that is when you buy an existing business, you can get terms. And that is exactly what I'm excited about real estate, right? I'm not excited about going and getting a bank loan at 8.5%. But if I can find a seller, I can give them their price, but I can get my terms. I'll do those deals all day. Does that also apply to entrepreneurships and buying a business, this idea of price or terms, your price, my terms kind of thing?
Yeah. And more so in business than real estate, because you have less buyers, less competition, and less exits, so the sellers. So
Good point.
their options are close, liquidate, walk away, or work a deal with you if you're willing to pay something or a premium. So in terms of what I'm the most bullish on, I'm in a different stage in life now than I was. I'm
Sure.
very bullish on the markets because I have ammo to deploy. But if you don't, you need money to make money in the markets. You can't go borrow and start with zero and get creative financing, and you got to have cash. So markets are great for people that have a lot of cash that they need to manage and deploy. So that can be good. Real estate, same thing. Real estate, you can do stuff on terms, you can do stuff without your own cash, but that's a longer term play. You can make money real quick in the markets in and out daily. Real estate, it's going to take a little bit more time. You can do some wholesale stuff and things like that. States are cracking down on that in different areas, requiring licensing in different areas, but there's still quicker moves you can make in real estate. But the big money in real estate takes more time.
Sure.
Millions of dollars on deals takes time. You're not going to make that in a couple of days, generally, in this market right now. But businesses, you can, because there's a cash flow, there's a customer base. And, when you look at where the biggest money has been made recently, the last 10 years, it's been with, startups, and especially particularly in healthcare, tech, energy, those types of things. That's where you can hit scale fast and do some really big things that you can't do in any of the other areas, especially starting with nothing, because you can start something with nothing in a startup, or taking over an existing company and scaling it, leveraging your vendors and your customers and your accounts receivables and all that. You can't do that necessarily at scale like you can in a business. In other words, you can't start today with zero in real estate and have $1 billion in equity in 6 months to a year. It's just not going to happen.
Right.
You can do that with a company. So that's where huge scale and the biggest scale and opportunities can exist for people.
Yeah, the other thing that I think is happening, this may very much be a Silicon Valley thing, but it's probably also tech hubs like Austin, maybe the Research Triangle in other areas, is talent. I think talent is going to be easier to accumulate over the next couple of years, at least in the Bay Area, the Silicon Valley. There was really an arms race for engineers, computer scientists, salespersons, and you just had to keep paying up. I think if we head into a white collar led recession, there's going to be some consolidation. I think Michael Burry put out a tweet the other day that 100 S&P 500 companies, worth, I don't know, $10 billion had an EBITDA of 100, negative 100 million. So I think there's going to be a lot of zombie companies that go bust. And when that happens, engineers, computer scientists get laid off. So I think starting a company, uh, again, we've seen what Airbnb, Uber, all of these folks kind of come out of the Great Recession. It's possible, the next billion-dollar unicorn will be created in the next crisis, and it's probably I would think it certainly happens. It's just a question of how many of those.
Yeah, yeah, they're created every day. I mean, obviously, it's easier in a bull market because there's so much liquidity sloshing around looking for a place to go. So it's easier to raise money. It's easier to, get those distorted valuations. We might not see that easy for the next few years. On the talent piece, yes, that's already happening. So companies are trimming the fat. The problem is they're getting rid of the least productive, least talented people right now. They're keeping the rock stars. So yeah, there's a bigger talent pool out there, but they're not the cream of the crop. Because that's who they're trimming.
Right.
And then, we're already seeing, like, on Wall Street, they're cracking down saying, hey, you got to come back to the office. You got to start working harder. This whole, entitlement mentality coming out of grad school these days. You want to work on Wall Street, you got to put the time in. So
if you want to work on Wall
already,
Street, you got to be on Wall Street.
that's already changing. That mindset's already changing, and those types of things. So the world as we know is changing. The worker in this world is changing, what they want, what they're looking for, where they work from, and things like that. I mean, it's very interesting times, and the pandemic has had so the last time we had a huge reshaping like we're seeing now was 08 and 09. I mean, that was a behavioral, life-changing thing that happened. And a lot of people that grew up in that environment and watched their parents lose everything in that environment, that was, generationally fundamental changing in the psyche of individuals during that time. People like you and me, we do business very differently now because of that experience. We know what can happen.
Oh,
in
absolutely.
terms of risk management. I had no risk management before 2009. I was just going, man.
Go.
It didn't matter. Everything was working.
Right.
Same thing after 2020, and really after 2009 on, it was much easier and much different, but particularly after 2020, just because, again, if you're a tech startup and you're in Silicon Valley, everybody was throwing tons of money at everything. Didn't matter. You didn't have to make a profit. Look at Kathy Wood's portfolio. Nothing makes any money in there. It was just up, 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 up. And, those days are gone right now. So that was and then from the workplace and remote work and all these things, that's a fundamentally behavioral shifting change, through that environment now that's going to be lasting for a lot longer. And it's really interesting how that's changed the workplace environment, how it's changed people culturally in terms of how they view, entrepreneurship and what they're willing to exchange their time for. It's really interesting.
Yeah. This is amazing stuff. You help people all over the world. If somebody wanted to reach out or follow you, how would they do that?
Yeah, gregdickerson.com. That's where all my info is. Go check it out.
Thank you, buddy.